We've been discussing the steps for auditing a company's purchasing process. In the last couple of videos, we discussed the need to understand a company's purchasing process and then to identify significant accounts and relevant assertions. In particular, we talked about accounts payable, purchase transactions, cash disbursement transactions. So now that we've covered those two steps, in this video, we're going to discuss how to assess the risk of material misstatement for the purchasing process. Now remember, the risk of material misstatement is a function of two things: inherent risk and control risk. So we're going to talk about each of these, and we're going to start with inherent risk. So remember, inherent risk is the risk a material misstatement will occur in the absence of any internal controls. We know that most companies are going to have internal controls to try and prevent material misstatements from occurring and catching them after they happen. But here we're just assuming there are no controls, inherent risk. What's the chance that account payable, for example, is going to be materially under or overstated? So when we think about a couple of factors that affect inherent risk for accounts payable, we can think about in industry-related factors. In particular, have there been any significant changes in the price or supply of the raw materials that company uses? Why does that matter? Well, if there was a significant increase in the price of raw materials, and let's just say that the company just had a single vendor that provided that raw material. So the price went up, there's just one vendor, they can't go to another vendor and get a better price. That's going to result in higher costs for the company, right? So higher costs, they're going to have higher liabilities. They might try to understate their liabilities and understate the corresponding expenses to kind of conceal the fact that, oh, there's been this big spike in costs. So we want to look at the company's industry, the supplies that they use, and say, okay, what's been going on with the price and supply of the materials that they're using. Okay. Also, we want to say, have there been any misstatements from prior audits that had to do with the purchasing process? If this company has misstated accounts payable in the past, then there's a much higher likelihood that we're going to have some kind of misstatement now. Okay, and this same principle we talked about in the video series I did on the revenue and collection cycle. If there was a misstatement in a prior audit, you automatically say, okay, there's going to be more inherent risk. It's basically like you've caught somebody cheating before, and so now they're more likely, there's a risk that you might see that they're cheating again. Now, we talked about inherent risk. What about control risk? Well, control risk, if you remember, the risk of material misstatement would not be either prevented or detected by the client's internal controls. So there's a lot of things we're going to do with control risk, and actually I'm going to make the next couple of videos on control risk and what we're doing to evaluate the company's internal controls, test the internal controls. But all starts with gaining an understanding of the 5 components of internal control. What is the company's control environment like? How does the company assess risks? What are its control activities? What kind of information systems does the company have? To what extent does it monitor controls? For example, you might look and say, okay, the company's board of directors, they've got an audit committee. How frequently does that audit committee meet? Do they take internal control seriously at this company? Okay. With respect to purchasing specifically, who in the organization has authority to make purchases, and are there any limits in place? Okay, some large organizations, you have different levels of managers, and maybe a low-level manager just has the ability to authorize purchases up to $1,000, but then maybe a higher level manager up to $5,000 or $25,000 and so forth. So understand who has the authority for purchasing, what kind of limits are in place. Also understanding how does this client's purchasing system work, and that would be done by doing a walkthrough. And as you're doing the walkthrough, the auditor would be saying, okay, not only how does the purchasing system work, but what internal controls are there in place. So you're noting that when you're doing the walkthrough. Then, in addition, so you understand the purchasing process, you do a walkthrough, you understand the control environment, you're going to do some tests of controls. Now, I'm not going to talk about tests of controls in this video, but in a future video, I'm working on it. We will have a video for tests of controls for the purchasing process, and we'll go through specific tests of controls that the company would use. Now, after you've tested the controls, the auditor can set what is called the achieved level of control risk. So I say achieved level because there initially is a planned level. So there's what the auditor initially thinks the level of control risk is going to be, but then they go and do some tests of controls and they might find, oh, you know what, the controls are not working as we had thought they would be. So then the achieve level, you can think about that as like the actual level of control risk. If that is differing from what the planned level was, if, for example, you say, oh, these internal controls, we thought they were going to work really strong, and they are not working strong. They're weak internal controls here. Then the auditor is going to have to compensate that by doing additional substantive procedures. And I'm going to make a video on substantive procedures for the purchasing process as well, so that video is on the way. Now, once the auditor knows both inherent risk and control risk, now they know the risk and material misstatement. Because remember, the risk and material misstatement, which I'll just abbreviate RMM, okay? So risk and material misstatement is a function of inherent risk and control risk, okay? So if inherent risk is higher, that's going to increase risk and material misstatement. Or if control risk is higher, that's going to increase risk and material misstatement, okay? And the risk and material misstatement is the risk that a material misstatement would occur, okay? It would happen, and it would get past the client's internal controls. It would not be prevented or detected. So RM, sometimes people call it client risk. The auditor doesn't have any control over this, okay? If there's a significant amount of inherent risk, or if the client's internal controls are weak, right? The auditor didn't set up the client's internal controls. So what does the auditor control? The auditor controls detection risk. Okay, right? And they do that by the amount of substantive procedures that they're going to be doing. Okay, so there's a certain chance that there'll be a material misstatement in the financials. We're talking about here purchasing process, accounts payable, thinking about purchase transactions, cash disbursement transactions. There's some risk that there's material misstatements there before the auditor does anything. So once the auditor understands what the risk of material misstatement is, okay, then they can set detection risk accordingly. And again, detection risk, this is affected by the extent of the substantive procedures that the auditor is going to do. So if the risk of material misstatement, okay, which again, that was inherent risk times control risk, right? So if the risk of material misstatement is higher, like the higher this is, then the lower detection risk is going to have to be. So if RRM is high, then the auditors are going to need to decrease detection risk to keep audit risk at an acceptable level.